The market is officially closed today, Saturday, May 9th, 2026. Looking back at the final minutes of Friday's session, Plug Power concluded the week at $3.12, reflecting a slight intraday dip of 0.32% on May 8th. While that $3 range might look like a quiet neighborhood for a stock that has historically lived on a roller coaster, the silence in the price action is actually masking a massive amount of tension building up for Monday afternoon. Most investors are looking at the chart and seeing a company that is finally trying to find its footing. But there is a specific development that almost no one is talking about yet. While everyone focuses on the upcoming earnings call, institutional activity has quietly shifted. We've seen several mid-sized funds like Towarzys Fundushi Investizinis and Equitable Holdings building out new positions over the last quarter. This isn't just speculative retail chasing a green energy dream anymore. There is a calculated accumulation happening behind the scenes that suggests the big players are positioning for a shift in the fundamental narrative of the hydrogen sector. The general expectation for Plug Power is almost a tired cliche at this point. People expect them to burn through cash, miss their timelines, and promise a future that always seems to be 12 months away. The market has grown cynical, and frankly, that cynicism was earned through years of dilution and missed targets. However, the reality we are seeing in 2026 is starting to challenge that cynical view in a very real way. The expectation is more of the same, but the reality is a company that actually grew its revenue by nearly 13% last year and finally saw gross margins move into positive territory. That is a massive psychological hurdle to clear. If you've been following the sector on your Fidelity mobile app or tracking the daily swings on the Robinhood app, you know that the path to profitability has been a punchline for a long time. But with the new leadership under Jose Luis Crespo, the focus has moved from aggressive, unchecked expansion to operational discipline and margin expansion. This brings us to the immediate catalyst. On Monday, May 11th, after the closing bell, Plug Power is going to drop its first quarter results for 2026. The consensus is looking for a loss of about 9 cents per share on revenue of roughly $140 million. If you are using SofiInvest or checking your individual brokerage for the latest estimates, keep those numbers in mind. The tension here is that Plug has a history of being a coin flip on earnings. They've beat estimates twice and missed twice in the last 4 quarters. But this time feels different because of the contract they secured in early April. They landed a 275-megawatt electrolyzer deal for a decarbonized ammonium nitrate project in Canada. This isn't just a pilot program or a small test site, it is one of their largest awards ever. This provides a level of revenue visibility that the company has lacked for years. It shifts the story from can they sell this technology to can they execute on the massive backlog they've already built. When you look at the broader momentum, the stock has actually climbed more than 65% since the start of the year as of earlier this week. That kind of run-up creates a very dangerous setup for earnings. If they don't absolutely nail the guidance, we could see a sell the news event that wipes out weeks of gains in a single after-hours session. On the other hand, if they show that the service revenue from their fuel cell systems is growing as fast as the 34% increase analysts are predicting, we could be looking at a total re-rating of the stock. Investors using interactivebrokers or other professional platforms are watching that service revenue line very closely because that represents the recurring high-margin part of the business that makes this look more like a stable industrial company and less like a high-risk tech experiment. Let's pause here for a second and get some feedback from the room. I want to know where the sentiment actually lies right now. Go ahead and comment below with how many shares of Plug Power you're currently holding, or if you've decided to move your capital into something more stable like Nvidia stock or Apple stock. I'm curious to see if the community is still believers in the green hydrogen story, or if the recent run-up is just a chance for people to exit their positions. If we look back at what this company actually does, it helps ground the recent volatility. Plug Power isn't just making fuel cells for forklifts anymore, though that remains a core part of their business with partners like Amazon and Walmart. They have built an entire ecosystem that covers everything from hydrogen production to storage and delivery. Their Rochester Gigafactory is a central piece of this, targeting a 500-megawatt stack capacity this year to drive down the cost per kilowatt. The business model is shifting toward a power purchase agreement style where customers pay for the energy they use rather than just buying the expensive hardware upfront. This is a much easier sell for large corporations trying to hit net zero targets without blowing up their capital expenditure budgets. The institutional side of the house is where the real story is often told. While the average person might be trading on the Robinhood trading platform for quick gains, the long-term holders are looking at the $1.2 billion backlog and the $8 billion sales funnel for their electrolyzers. When you see a company like SK Group or Renault forming joint ventures with Plug, they aren't doing it for a short-term trade. They're doing it because they believe hydrogen is the only way to decarbonize heavy industry, shipping, and long-haul trucking. Batteries are great for a Tesla stock play, but you can't run a massive chemical plant or a cross-ocean freighter on lithium-ion cells. That is the reality that is eventually going to collide with the market's low expectations.
Looking at the future outlook, the risks are still very much present. Interest rates and macroeconomic pressures can still weigh heavily on capital-intensive businesses. If the cost of building these hydrogen plants stays high, the timeline for true profitability gets pushed out again. There is also the competitive landscape to consider. While Plug has a head start, other giants are moving into the space. But the catalyst for the next 6 months is going to be the execution at their new production sites. If they can prove they can produce green hydrogen at a cost that competes with diesel or natural gas, the stock isn't going to stay at $3 for long. We are at a point where the expectation is a modest quarterly report, but the reality could be the beginning of a sustained turnaround. If the Monday report shows that margins are continuing to improve and that the new CEO's focus on operational scale is more than just talk, we might look back at this $3.12 price point as a gift. However, if the cash burn hasn't slowed down despite the revenue growth, the market will likely be unforgiving. It's the classic tension between a visionary narrative and the cold, hard numbers of a balance sheet. You can have the best technology in the world, but if you can't make it pay for itself, the market eventually loses interest. In summary, we have a stock that has found a rhythm in 2026 that we haven't seen in years. The transition from a speculative growth story to a maturing industrial player is underway. The contrast between the lingering skepticism from the past and the actual operational improvements of the present is creating a unique window of opportunity. Whether you're managing your own trades through SoFi Active Investing or looking for more professional investment help, the data suggests that plugpower is no longer the same company it was 2 years ago. The leadership has changed, the revenue mix is shifting towards services, and the contracts are getting larger and more consistent. The reality is finally starting to catch up to the expectations, and Monday's earnings will be the ultimate test of that theory. Keep an eye on the volume and the institutional flow, because that is where the real move will be telegraphed before the rest of the market catches on. It's going to be an interesting week for anyone holding this ticker. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, bell subscribe for more updates.